Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to another episode of Investment Matters. I am your host Adnan Bazir, and in tonight's lineup we'll be doing the weekly market update with Abdurauf Hanslow. We'll then continue with our financial planning episode with Mohammed Jaffer, and then we'll continue our series on estate planning with Mr. Shaukat Mukaddam. So do stay tuned as we'll be going over to Abdurauf to take us through the weekly market wrap. Shukran. Assalamu alaikum and welcome back to Investment Matters. We do have Mr. Shaukat Mukaddam, the guest speaker from Legacy Fiduciary Services. Assalamu alaikum, Shaukat.
Well, Islam Adnan, it's good to be back also again.
As we wanting to continue our series on estate planning, we briefly ended off last week on looking at the mechanisms used when we're talking about estate planning. Let's just unpack that for the viewers.
Now, basically, there are four mechanisms. One is the donations, the wills, the trusts, and the insurance policies. Okay. And just to touch each one briefly, obviously one can go into detail, but essentially in the case of donations, every individual is allowed to pass on 100,000 Rand per tax year to anyone else without any further tax consequences. So typically a father can give a child 100,000 Rand, yes, and there are no questions asked about it. But by doing that, over 10 years, the father's actually relieved himself of about R1 million of wealth. And the whole idea is to come within that threshold of 3.5 million Rand. So between father and mother, you actually can do 200,000 Rand a year, and over 10 years, you actually have dissipated 2 million Rand of your wealth. Obviously, you can put this wealth in the hands of your children, you can put it in the hands of trusts, particularly, which can benefit them, and we will talk about trust later.
I mean, if you're just mentioning that now, the 100,000, if you're looking at a property or house, how do you then break that down, that 100,000 per year?
Well, I think the point is, first, it's easier done with cash.
Okay.
I mean, that's the first point. And secondly, it's 100,000 for every tax year. So those of you who have not done it, end of February is around the corner, take advantage of it and do it. Okay. But if you wish to do it as part of assets, you would then have to transfer shares in the company with the value of 100,000, or transfer 100,000 of the property, and therefore the child's name will go onto the title deed, or the trust's name will go onto the title deed. But the preferable way is actually to pay the money across. You can't pass journal entries to justify it. The best way is to pay it across. But the whole idea is that over 10 years, you can easily relieve yourself of 2 million Rand of wealth that would be part of your estate. The second part of donations is any donation between husband and wife, irrespective of the amount, is also free of donations tax. So if you above 3.5 million Rand, you can give the excess amount as a donation to your wife. So if you believe you're at 4.5 and that's going to impose estate duty on you, you actually can give R1 million during your lifetime to her without any tax consequences. The only issue is when it comes to property, you have to pay transfer duty. But there's no income tax consequence, there's no capital gains tax consequence of that decision really. So people out there should be using this mechanism from that point of view. The second one is a will. A will is a good instrument because it gives you two mechanisms of estate planning. One is within the will, you can actually bequeath to your spouse an amount so that your threshold is not achieved.
Yes.
Okay, so you can make a bequest in a will to your spouse of the house, of the R1 million, whatever the case is. So if you've missed it out in your lifetime, you can use the will to make a bequest, particularly to the spouse, and because that amount is as a deduction in the estate duty calculation and also does not attract capital gains tax, it is a good mechanism to pass on wealth. Obviously, if it's serious amounts, she ultimately will pay on it when she dies if it is above 3.5 million Rand, because death taxes is payable by an individual on his or her death effectively. The second one, which we also encourage a lot, is any contributions to a public benefit organization, like the Red Cross Children's Hospital, SA National Zakah Fund. Be careful, it must be registered as a public benefit organization. So any amount that you leave in your will for a public benefit organization ranks as a deduction and reduces your estate duty. So again, you reduce your wealth taxes payable or death taxes payable on that really. The third one is a trust.
Yeah.
It's used for many. In fact, trust is its roots are within the Islamic concept. We know many people and many Sahabas have established waqafs, and the roots are actually right back there.
Yes.
The modern trust that we have. But essentially, when you place the assets into a trust, it does not belong to you on death, and therefore you will not pay on the market value of that asset, because that asset now belongs to the trust. Depending on the value you transfer the asset, that value could be as part of your estate. So typically, if you've got a business and you have to sell the asset to the trust, it was in your name and you sold it for 4 million rand, the 4 million rand will be in your estate because it's a loan. Any growth on those shares above the 4 million rand will then take place in the hands of the trust. Typically, your family, your children are beneficiaries of the trust, and indirectly, they will have the benefit of the assets. So it's a very good mechanism. We call it freezing the estate. Or you could, the very first time you acquire an asset, you could put it directly into the trust.
Yes.
So from day one, the growth takes place in the trust. Within a will mechanism, a very good tool is always to leave substantial assets to a trust for your child. Not to the child, but to a trust for your child. We call that a testamentary trust.
Yes.
In that way, whenever that child dies, it hasn't got an estate, because the asset was bequeathed to a trust for that particular child, effectively. So that's the big benefit of a trust, that you don't have the assets. A trust doesn't die when you die. There's no estate around those assets. It's only the assets in your hands. And so you can imagine, if you're very smart and you organize your life around that principle, you actually can organize it in such a way that you don't actually have an estate.
Yes.
Effectively, effectively, you can just ensure that you're below the 3.5 million rand, effectively, from that point of view. A trust is also used where you're worried about children, how they're going to behave, how they're going to manage the assets. Sometimes the children, are delinquent. The children are using substance abuse and so on. And therefore, a trust is a good mechanism also to protect vulnerable children, minors, and also the spouse in that case, irrespective of the amount.
Of course.
So a trust is formed for any amount of assets. There's no criteria as regards the amount. I think it's really the objective and the purpose, really. So even if you've got 500,000 rand, but you're concerned that your child is going to waste that money, you could put into a trust, and the trustees will manage that money for that particular child, really. Ultimately, the final one is insurance policies. Obviously, there is a big debate whether it's permissible or not, but life insurance policies do provide cover for death costs, and it's a good mechanism, particularly to cover costs. And certain ulama have indicated that it's permissible to have life cover to assist you in covering death costs and settle the death costs, which can be substantial.
As a priority in terms of covering those costs, and not as liquidity or cash for the inheritors.
Definitely, just to cover the cost. So it's good to work out that figure, take the life cover for that amount, and therefore you know that the assets won't be touched, because the death costs, which has been imposed by the government, is then covered by this life policy.
I mean, you've touched on donations. Can you donate to a trust that you've set up?
Yes, exactly. So you can use your 100,000 annual donation, because that donation can be to anybody. So you actually could set up a trust for your family, donate 100,000 every year. Over 10 years, you've actually moved R1 million away from yourself into a trust for the benefit of your family, effectively. So they actually have access. But the important thing is that you have reduced your wealth, and it's still under control of family members.
Shaukat, in the next episode, we'll look at the Sharia implications in terms of wills specifically, and for estate planning as well. But shukran for your do say to you next week, as we'll continue our episode on estate planning. Shukran. Assalamu alaikum wa rahmatullahi wa barakatuh. Assalamu alaikum and welcome back to Investment Matters, as we'll continue our series on financial planning with Muhammad Jaffer from Mojaf Financial Services in the studio. Assalamu alaikum, Muhammad.
Wa alaikum salam, Adnan, to you and to the viewers.
Muhammad, last week we sort of introduced the aspects of now putting the financial plan together, and you've introduced cash flow management and sort of trying to understand what that means. And then we sort of touched on investment management and moving into retirement planning. So I think that's probably where we would like to focus on it now.
Yes, Adnan, we would like to continue with, as we said, we mentioned last week the different aspects of financial planning and what is that plan all made up of. And we covered cash flow management, and we're now going to start with investment planning. And our investment management of the plan has got different aspects of it. There is included in there is emergency funds. It's important that there is some money put away towards emergency funds, because
Yes.
you know life can throw us a curveball at any time, and we need to have funds in a case of an emergency, that I know that I've got some funds that I can quickly access. It must be funds that you can access at literally at the drop of a hat. So we've got emergency funds, and in there we'll talk about unit trusts.
Yes.
It will be made up of shares. We'll talk
Yes.
about that. Then what is our capital needs? We need to save for our capital needs. I want to make a renovations to the house, or I want to buy a car, which is maybe I want to buy a car cash.
Yeah.
And then also property as an investment, or as I call it a liability, which is the house that we build in.
Yes.
Many people think that the house that I live in
yeah.
is an asset. It's not an asset. It's
Yes.
actually, in my view, it's actually a liability.
Yes.
Because you're not deriving, other than a roof over your head, you're not deriving any financial benefit out
Yes.
of it. But we'll talk about that. Now, Adnan, it's important when we talk about unit trusts. Now, unit trusts of collective investment schemes.
Yeah.
I prefer to use the word unit trust because everybody knows what we're talking about. Now, unit trust itself can be a fantastic investment vehicle. Maybe before I touch on that, let's look at shares. Now, a unit trust fund is made up of a collection of shares. Now, a share would be typically, I would buy a share in a company, like for instance Cecil or PPS or PPC or MTN. Those are maybe the big blue chip that we're mentioning. But by me investing in a share, in an individual share, my investment will be determined on the performance of that individual share. So as an investor, I need to understand the volatility and the risk that I'm taking by investing in one particular
Company.
share.
Yes.
But also, that share will also be influenced by what happens in that market space.
Yes.
For argument's sake, what happens if we talk of, for argument's sake, Group 5 as a
Yes.
share. Now, I need to also understand that share particularly is also in construction and
Yes.
building. And so, use a typical example, we know since 2008, the building sector, for argument's sake, has taken quite a pounding and a hammering
Yes.
in the investment sphere. So you need to understand not only that share, but in the sector in which that particular company is operating.
Yes.
Because depending on what happens in that sector, it will obviously influence my share,
Yeah.
my investment. So you need to, as an investor, need to understand that. Now,
I'll
it's
probably,
not all-
just to add on to that, I mean, with a share, you obviously, you buying the share or have access on the open market to buy a specific share, and you then would have to take that responsibility of analyzing the performance of the company, how they're doing, and watching the share price as
absolutely, Nan, that is that you spot on there. You as the investor need to then analyze the company,
Yes.
need to understand the dividend policy of that company, because you find that there are many companies that would not declare dividend. They would rather reinvest the money, the profits that they make.
Yes.
So you as an investor need to also determine, do I need the dividends, or do I actually want the dividends? Because a dividend income, or as we call it, a dividend stream
Yes.
from a share is also very important.
Yeah.
So there are not many people that has the skills, that have the ability to do all these things.
Yes.
Hence the reason we talk of unit trust. Now,
Yes.
unit trust, where you have, as you know, Adnan, you would have a fund manager, and then the fund manager would be surrounded by his analysts that will analyze all these companies. The example that we've used is the Group 5, the construction sector. Those analysts will analyze the sector, and then it will drill down into that specific share, that company, and give the fund manager all the information about that particular sector and that share.
Yes.
And a person like Abdul Aziz of Kagiso Asset Management will then decide, do I then buy that share now or do I sell that share?
Yes.
And you have a wealth of experience in those managers that does all that, because he's got a team of advisors and a team of analysts around him to do all that work.
Correct.
Now you as an individual, Adnan, I'm not underestimating the ability of people, but there are very few people who's got the ability and has got the skills to do all that.
Yes.
So this is where unit trust comes in.
And it's time consuming.
Very time consuming, and also you need to understand the market, you need to look at the market, you need to read the market, and many a times, Adnan, in fact my son is one of them.
Yes.
They want to invest in shares and they want to make quick money, you know, and this again, there is no, I always say there's no such thing as a quick buck. And we've seen so many investment schemes that has collapsed, where people were promised that they can get 10%, 11% over a prolonged period of time. Now, unit trust, Adnan. Unit trust, as we know, that there's roughly just under 500 shares on the Johannesburg Stock Exchange.
Yes.
But you've got almost 1,000, in fact more than 1,000 unit trusts. You know, it just shows you that there are more unit trust funds than what there are shares.
Yes.
And the reason for that is that, use a typical example, you would get a unit trust fund that would focus on property. Then you would get a unit trust fund that would focus on resources,
yes,
mining and the resources. Then you would get what we call a general equity fund, which would be shares in different, it would hold MTN, it will hold PPC, it will hold all the different
sectors, yeah.
There we go, Sasol and that. Then you would have, within that, you would have different level of risk.
Yes.
You know, you would get high risk funds, you'll get moderate funds, and you get conservative funds. Now, the advisor needs to explain to the investor how this fund could perform in a certain market, and you as an investor needs to also be categoric and clear as to what I want to have or what my expectations are over the next 5, 10, 15 or 20 years. Because investment planning and investing is not, Adnan, is not a short-term goal that we're setting ourselves. If you want to have a short-term goal, not talking, even I would talk almost less than 5 years or 3 years for that matter, then rather go and play.
Because then you're basically wanting to save rather than invest. There's a difference.
There we go. I think you spot on. There's a difference between investing and saving.
Yes.
If you want to save, you're saving for something, then you wouldn't want to take too much risk with it. Then you would look at for argument's sake, an income fund, a balance fund, or for argument's sake, even a property fund, a fund that, or a dividend fund that would give you some dividends that you could utilize. You know. So, Adnan, I would like to go in the next program us to continue with unit trust, because I think it's very important that people have an understanding, and not because by not understanding, people tend to make wrong decisions, and that can be detrimental to you.
Of course. Now we'll definitely continue on that, Mohammed. Shukran for that. Do join us again next week as we'll continue on our financial planning series. Shukran. Assalamu alaikum.